Hello everyone. Welcome to another chapter of Unit of Technical Analysis. Here we are trying to cover more of basics. We have already covered few of the chapters. For example, we have covered Fibonacci. We had two parts in this, part one and part two. Then we covered trend line. In trend line, one of the most important thing that we covered is, let's say, for example, our previous bull cycle, which started on 24th of March. The low over there was 7511, and the high of our bull cycle, which happened 6 months back, is 19th of October 2021, which was 18604. Now, if we consider the range overall for these two numbers, which is there, that comes to around 11,100 to be precise, right? And the number of days which was there is 574. Now, if we divide 11,100 points by the number of days which is there, we get a figure which is 19. So on an average, every day market has been moving by 19 days. And if we consider that in number of days, which is trading days, because these are number of calendar days, not trading days. By number of trading days, it comes down to an average of 25. So we can get a conclusion that every day the market has been moving somewhere around randomly by 20 to 27 points approximately. So that is how it is. So that was regarding the trend line. Next, we had covered how to use TradingView and investing.com. Basics were been given, not more of is in details actually. And now we are going to cover moving averages. Now, before going to moving averages, let's try to see what is average so that we understand the basic difference between average and moving average, right? So average is what? Approximately, if I see these are six numbers, and if I divide this six numbers together by the number of numbers, which is, let's say, six, right? So 5 divided 5 into 6, that is 30. 30 divided by 6 comes to 5 approximately. So that is the number that we get, 5. And if I keep on changing numbers over here, let's say I change this 3 numbers. So my moving average accordingly changes, right? And again, if I change the numbers, 9, 11, again my moving average changes. So this is more about average. I can take down any number as high as 1000, and then maybe, so any random numbers which are there, we take that, take those numbers, have a sum of all those integers together, and after that divide by the number of numbers which are there, right? So we get an average for that. But what happens is, for our part, let's say we are considering, yes, so these are our candles. So what happens is, if I consider an average of 1, 2, 3, 4, 5, so these 5 candles, I'll get an average, right? And if I'm consider only a moving average of 5, I'll be able to consider this 5 candles for this day. Now for the next day, what would be happening is, if my moving average is 5, it will exclude this candle and consider for previous 5 candles, which is 1, 2, 3, 4, 5. So this average which is there, that keeps on moving depending on the candle. For example, if I consider this candle, so it would be 1, 2, 3, 4, 5. So what happens is, every day the latest 5 candles or the latest of the moving average number is being considered, and it exclude the previous number of candles which are there. So if a new candle is been added, the previous one candle is been excluded, right? You got the basic difference between average and moving average, right? Before going further, let's try to find out how we are able to add moving average. So on the top horizontal bar, if I go here, it is indicators, right? I click on indicators and I put down, you can either put down moving average, right? You will get it over here, or you can just put down MA. Either of them, either way you are able to get it, right? So I click on moving average, right? And on the left hand side, top hand side, just before the name of the stock or the index, you get MA, moving average, which is given, and this specifies that the moving average is been considered for 9 number of previous candles, right? Let's go into formats, that is settings, and then we'll be able to change it. For example, let's say I consider it for 36 days, right? And I change the style, probably making it a bit darker. I keep it line only. If you want to keep it as a line hologram, but standard it is being used as a line. So let's try to keep that. And if you want to change the number, you can do that also. If you want to put down yellow or maybe some other color, definitely you'll be able to do that. Right. So this is how you change that. Right. And see, moving average, first of all, this is how you draw the moving average. Right. Now the moving average may not change immediately. If you want to change immediately, probably you can do that also, but you need to change down smaller number of candles, which is there. Let's say, for example, 5 is there, or standard generally 9 is also being used. That is for another type of moving average. We can get into that details also. It depends how much number of candles that you want to consider, but it also depends on the time frame that you're using, right? You'll see also time frames, what are there and how to use that. But on an average, this is how a moving average is being considered as an indicator. Right? So that is the basic difference between average and moving average. As I told you, the significance is this is a trend indicator, right? Trend indicator is, let's just give me an idea, right? There are four basic types of indicators which are there. First is trend indicator, momentum indicator, volatility indicator, and volume indicator. So from that, this is a trend indicator. So it indicates to us about the trend, how good the trend is. This can be short-term trend, this can be long-term trend also, right? So significance is about trend indicator. There are various types of moving averages, but we'll talk only about two ones. One is simple moving average, and second is exponential moving average. Or I'll put down separately exponential moving average, or it is called as EMA also. Right? We'll study the difference also. But as I told you about time frame which is there, now there are various time frames which are being used. Let's say, for example, if you want to go for a smaller time frame, probably let's say like intraday or something like that, you can go for 9 or maybe probably till 12. If you are going for a longer time frame, let's say you want to go for a month's time approximately, starting from 2 days to more than, or let's say 15 days or even 30 days. So you can use a midway indicator somewhere around 36, right? It depends. I mean, like you can start from 15 or you can go up to 36 also, right? And if you're going for a longer time frame, maybe more than a month's time, 3 months time, 6 months time, a year's time, 2 years time, you can go for various other indicators like 100 days moving average, 200 days simple moving average, right? So these are generally be used 100 days, 200 days, right? So it can be 100, 200 days moving average which can be used. So we saw this, and let's say we can have different kind of moving averages also together, and we'll go for one more moving average if you want. Try to see the difference. So for example, if I see here, I'll keep this 9 and I'll use one more, which is for let's say like a bigger time frame. I'll keep that as 100 days moving average. And I'll also change the color. I'll keep it to probably green. Right? Right. Now, if we see the moving average altogether changes. So these are all moving averages. Only thing is we have kept the time frame in a different way. I'll keep this time frame maybe let's say 36. Right. Now what happens is, let's say after the bear cycle, right? See, this moving average is not been changing fast. This moving average is not been changing fast. But this one, the 9 one, right? Which is the lowest one? The lowest one starts moving first, right? So first of all, if you want to find out a change in the trend immediately for a shorter time frame, you can use for shorter time frame also, as we told and saw over here. For a smaller time frame, let's say for intraday purpose, or maybe for daily purpose you can use 9, 12, something on a shorter time frame, because it makes the change faster, right? That is the first thing. Second is, you saw this which is for 36. So 36 made a change probably after that, right? When it had already gone, maybe probably was starting moving up, right? And after that probably this started moving up, right? And the third one, which is green, was 100 days moving average. That started moving after that only. So it was somewhere around maybe in August. And from March onwards till August, maybe probably after that, it started moving positively, right? So that is depending on the different kind of moving averages and how you should be able to take positions for those on different things, right? So this is about moving averages and the time frames which are there. The shortest time frames gives you changes faster, right? So if you want to take trades on the basis of moving average, how to take those trades? Let's try to find out and understand that. We'll quickly take two, three different examples which are there, and then probably after we will also see the moving average crossovers. We'll also talk about the other moving average, which is exponential moving average also, right? Let's say, for example, if I'm able, I want to take a trade in Nifty, right? So for Nifty, what I do is, I first of all, whenever I want to take an entry, I'll first of all see the moving averages. It's not necessary that I should be seeing only one moving average. I can see different moving averages also together. But for the changes which are there, I should be looking for the shorter time frames, right? Now what happens over here and how we should be trading? Let's look at that, right? So this moving average is going down. So still it is there in downtrend. I'm able to find out or see some changes over there, right? So for this candle, I'm not able to immediately trade, right? Why? Because this is showing probably a bullish divergence or maybe bullish engulfing over here, right? So if you are trading on the basis of, let's say candles, definitely I'll be able to take a trade somewhere around at this level when it goes up, right? For moving averages, probably I need to wait for one critical indication that the trend should be changing in upward direction. See, for example, over, if I see the price has been moving up, but the moving average is still going down. So I'll see for moving average, right? For my this line, right? It's been shown over here. So for here, the moving average is still 8591. It is still going in downward direction. It is not moving above. It is still down 8445, right? So here it was 8591 and it has come down 8445. Here again it is down, which is 8386, right? Here again it is down 8309, 8324. So at this junction, probably somewhere the moving average has just started moving up, right? But is it consistent moving up? See, from 8324, it has started moving. It has again come down. So it is 8323. Here at this candle, it is again 83 8249. So probably from this candle to this candle to this candle, it is not again moving up. So over here, I see again a positive move, that is 8249 and 8381. So this is a candle which gives me an indication that, okay, fine, the moving average is also trending in upward direction, right? I hope you got the difference. I won't be trading at this point. I won't be trading at this point, but probably at this point, when I see that the market has moved above the moving average, I can take a trade over here, right? Because the moving average has also started moving in upward direction. Maybe probably at this day or maybe at next day, whatever it is there. It depends on you. If you want to take a trade at the top or maybe above this candle, definitely you can do that, right? But here gradually you come to know that the trend has started moving up. We need to understand that there are two important things. Is first, the price has started moving up. That is the first moving important thing. And second thing is, with the price, the trend of my moving average has also started moving up, right? I hope you got the difference. I'll tell it to you again because this is critical to understand. The moving average over here, see, you can see the moving average been defined here. I'll just do one thing, right? I hope this is clear now, right? See, here the moving average is 8591. it is still in downtrend. 8445 still in downtrend. 8386 still in downtrend. It is moving down. 8309, 8324. So at this part, it has just showed me a positive significance which is there, but still moving average is not giving me that much of upward turns. It is just an average nearer to that. Again, at this candle, it is moved down. See, from 8324, it was come down to 8323. So it is almost like in sideways movement. Here again, it has started moving up from 8323. No, again, it has moved down 8323 to 8249. Right? So it has again moved down. But over here, if I see from 8249, it has gone up to 8381. Right? Because the previous candles has not been taken into consideration, but the nearest candles which are there, the 9 nearest candles have been taken into consideration. So here onwards, we get that change which is been required. Here we are not able to get the change, but here definitely we are able to get that change. Right? So from here onwards, I see that the moving average has been moving consistently in upward direction. So I can take a trade over here and I can continue till the point the trend is there in positive direction. Right? So for example, here again it is in positive direction. Right? Again, if I see, yes, it has again started moving in upward direction. Right? Again in upward direction, again in upward direction. Right? Again, it started moving up and the trend has continuously been moving upwards. Here it had come down. But again, if you see the moving average has been moving, it has been more of in sideways. It was not come down drastically. Right? Here it had come down, but till that time the price was already up. Right? Again, the moving average is still up, still up, still up, and from here it did pick up and go up further. Right? So again, it went up, it went up, it went up. If I see at that time, probably for the average of 36 as well as 100, yes, those are also in tandem. They are also moving up. Here it is a shorter one, so probably there are some crossovers which are there. But again, if we see, yes, this has also started moving up and this has also started moving. So we see that okay, the long-term time frames are also positive, right? And it is still moving up for all the points. Here probably it has just come down at some time. But if you see the moving average is there for 36 days or maybe for 100 days, 100 moving average, it is still in upward direction. So if you are in a long position, probably you can take a consent of the other moving averages also, where you know that okay, fine, this has been taking support. Why? Because the 100-day moving average is still in positive direction. It has been just taking supports and it has started pushing up. Right? See here, it at probably at this juncture it started giving us crossovers. But here again, if you see, yes, it was still an uptrend, and over here probably it started moving in a downtrend direction. So if you are a long-term player, probably once you know that your moving average has started coming down, right, and it is not going beyond this point, probably this would be a termination point, right? Because till here my moving average is still up. For example, if I see over here, I'll probably just freeze this moving averages and see only for the 100 one, right? It is still positive. It is 595, 600, 640, 640, 639. So probably here it has just started moving down, right? 638, 640, 645, again moving up, 647, 648, 646, 644, 42, 43. So here at this point, I know that, okay, fine, it is not crossing the moving average and probably it started moving up. So probably I'd be able to trade my stop loss, maybe probably best at this level, because here onwards, the moving average has also started coming down, right? And if I see now at this stage, probably the best to take trades is when it has started moving up, and probably over at this point, if I need to go in downward direction, this probably would be my best point, right? Because it has crossed up and probably after that, again, the price has moved down. It tried to cross over here, but didn't go. So it was probably at this point or maybe at this point where I knew that, okay, I should be able to take long trades, right? So how this is how it is. If you want to take maybe probably long trades, you should consider the longer time frames. As I told you, we have considered different time frames, 9, 36, 100, which are there together, and we also try to take trades on the basis of those time frames. Now let's try to see other examples also. Let's say, for example, here we have Tata Steel. So probably I'll just try to take an example for Tata Steel also. I'll go for first of all candles and then go for moving average. Right. So I've considered three. I'll first of all go for the longest one, which is 100. And again, do the same thing and put down the color which we had used previously, green, making it dark. Then the second one was, we had considered 36. So consider 36 and probably change the color. Make, try to make a bit dark. And third, I'll keep it as it is. Let's say, for example, during the bull cycle, somewhere around at this part, let's say, right? I knew that, okay, my long-term trends were still negative, right? But here gradually probably I got a crossover from here. Crossover in sense like the moving average. It has probably taken support at the 36 moving average. So here I saw that, okay, fine, the moving average has started moving up. So probably on the basis of that 36 moving average, when I know, let's say, I'm taking 36, so I'll only consider 36, that is 279, 278, 276, 276, 275, 275, 276. So this is the candle probably where it gave me a positive confirmation that it has started moving up. So I can take trades probably over here or here. Once I take a trade, probably at the bottom, I'll keep my stop loss and wait for the trend to move in upward direction. So here it is still moving up. At this point, I got a positive confirmation that the trade is moving up for long term also. Here the trade is still going in upward direction, right? Here again it is moving in upward direction because the moving average is still positive. It hasn't come down, right? And with that, my long term moving average, which is 200, that is also moving in upward direction, right? Here if I see, probably I got a crossover. Crossover means like the bigger time frame which is there, let's say for 100, right? It was still positive or probably somewhere around this part it got negative, right? So probably at this crossover I can just trade, or probably when it starts moving down I can trade my trade and move out of the trade, right? So that was talking about moving average. We saw simple moving average. This was all on the basis of simple moving average. Let's see what is exponential moving average. Now what happens is, as we saw, For simple moving average. Simple moving average took into consideration all the candles. Let's say, for example, 36 is there. So for last 36 candles, it would be taking an average, which is a simple average of all the sticks together, all the candles together. It won't be giving any kind of weightage to any of the previous candles. But for exponential moving average, what happens? It specifically gives more importance to the nearest candles. We'll show it how. See, for exponential moving average, what happens is exponential moving average gives more importance to the nearest candles which are there, like the previous candle. So this is the formula. You can get out more of in details for that part. Just try to take an example of that. Probably I'll remove this one and just keep these two, and we'll see exponential moving average, right? So for exponential moving average, generally the time frame which is there, that is the nearest one which has been considered, right? So again, try to see both the examples. This was the first example that we saw. Here we'll do one thing. We'll probably just try to see one small change. We'll keep the moving average also, and we'll try to see the difference between these two moving average. I'll keep this probably yellow, and just to know the difference, that's it, right? So the yellow one is my moving average, and the one which is there in blue color, that is my exponential moving average. Right? So if you see, while my moving average, the yellow line, has been moving slowly, my exponential moving average would be giving me an indication just before the yellow line gives me an indication. So it has been moving up quickly and it has been moving down quickly. Here also, if you see the movement which is there upside, that has been quick. Let's remove this. We don't require this. When it is going up, it has been moving up before the yellow line which is there, because this is an exponential moving average. Even when the value for both of them is 9, right? See, even if we see for the crossover part, when it has been going positive, we see that the the blue line has been moving faster just before the yellow line, and it has been above that yellow line, even when it has been 9. Again, if you see the change also, the changes have been happening faster. Why? Because the blue line which is there, that has been giving importance to the nearest candles. For example, here, as soon as the red candle came in, it probably started just moving down. So this is more of for entry and exit purpose. People do trade on the basis of those crossovers also. Let's say, for example, if I want to consider only those two ones, right? So when I get an entry, or probably when I know that, okay, it is moving above this, probably I can take a trade, right? When it is just moved above it, I can take a trade. And when I know that, okay, fine, it has gone up, and probably just when this crossover happens, I can exit, right? But for this, we need to also consider the moving average, which should be again moving in upward direction. For example, let's see. Here we got a criteria that the moving average has been moving up and it has also been trending up. Trending is like the moving average is also been going up. So that is called as a trend, because this is the trend indicator. We need to follow that. So when it goes up, probably at this level, when it gives me a crossover, after that I can enter into the market when it is moving up. Like when it moves up, after that I see that, okay, fine, it has been going up. When it goes up, and probably when it gives me a crossover over here, probably I can just exit, right? Again, when it starts trending up, probably it has been trending, but this is going down. We need to know and have both the things moving up in upward direction. Probably over here, I get a crossover where both the things have been moving up. So I got a crossover, and here again, I got a crossover where the candle has moved up. So at this level, or maybe probably at this one, I can just take a trade. Now both of them are in upward trend, so I cannot lose my trade. Both of them are moving up. They are moving up, moving up. Here probably I got a trend that okay, fine, they are moving down. Right. So when I get a crossover over here, probably at this time I can just terminate my call. Right. After that, I again wait for an upward trend. So probably when it gives me a trade for downward direction, at this cross, I can go for selling purpose. So when I sell it across, it goes up, it goes up, it goes up, it goes down rather. I beg your pardon. And when it starts moving up again, if in upward direction or maybe in uptrend, both of them are moving in uptrend. So over here, when the yellow line goes up, probably I can just terminate my trade. Or maybe at this part when it gives me a crossover. Because this is still down, this is still down. And when it starts moving in upward direction, probably I can close my trade. Right? So this is how you can work with crossovers. Crossovers again, it depends on the time frame that you are using, that you'll be able to use this different kind of time frames. So if you're going for a shorter time frame, go for shorter time frame. You can also have a combination. For example, this the exponential moving average is 9. So here you can go for a bigger one also. Let's say like 12, 16, 20, 25, 36, whatever it is there. Right? You can go for those. And on the basis of that, you trade. Generally, I use moving average for long-term trends because that gives me a specific idea, or otherwise for shorter time frame, it keeps on fluctuating over a period of time. Bigger time frame, it gives me a better idea for all those things together. So I mostly prefer for going bigger time frames rather than short time frames. And that you can also use with bigger moving averages. Let's say, for example, 36 or maybe 100. Whenever you get that kind of bigger crossovers, let's say, for example, I'm using 36 and 100 crossover. I'm not still getting that. Both are in uptrend. When they start moving, for example, this has started moving in downtrend, right? And it comes down. So probably at this crossover, when this is still positive and probably this is started moving down, I can take or terminate my trade over here, right? So this is how it is about moving averages. So we saw simple moving average, we saw exponential moving average, we saw about different time frames which is there, and we also saw about moving average crossovers, and we also saw how to trade this time frames, right? So guys, this is all about moving averages. Generally, we try to prefer using moving averages not on standalone basis, that is not alone, but this should be used with other indicators like, let's say, RSI, MACD, and others, which gives you, or maybe Bollinger Band also, which gives you better results or effects, right? Or it can be also used with candlesticks, right? So we'll see that gradually one by one. For now, we'll end this session. Thank you.